Nebius, or NBIS stock, is one of the fastest growing AI companies out there. Frankly, if you think there's a faster growing company, please call it to my attention in the comments below, because this is, as far as I can tell, this is it. I mean, you see a company growing by 9x, nearly 9x year over year, from $5 million to $43 million. It is quite interesting. So in this video, we're going to walk you through, sort of what's driving this growth, where are they potentially going in the years ahead, as well as my thoughts on the valuation. My short personal conclusion is that it's a little bit too hard for me. I'd like to see a little bit more proof before I consider buying in, but that doesn't prevent them from growing by several 100% in the years ahead. So let's walk through right now, what do they do? If you enjoy educational investment videos, you're watching Unrivaled Investing. Let's dive in to understand what's driving this incredible growth. First of all, it is worthwhile to understand their largest shareholder is Last Star Trust. They also have majority of the vote. Last Star Trust is a family trust for Arkady Volos, who's the founder, CEO. He previously founded Yandex, which is one of Russia's biggest tech companies, previously worth tens of billions of dollars. And Nebius effectively comes indirectly through Yandex. And this is an interesting development, because what ended up happening was that after President Putin from Russia invaded Ukraine, shortly afterward, Volos, he put out a statement saying, look, this is a barbaric. He left Russia, went to Israel, went to Europe, and President Putin called him a talented businessman and wished him good health. You might go, whoa, why is saying good health? Because usually that's like a suggestion that you're going to take up flying lessons from the 10th floor of a building, which has happened to a lot of, Russian executives, where all of a sudden they go, I don't know how he fell out of a window, just bad luck, I guess. I mean, so he's like, oh my goodness, I need to hire a security detail, even though he's no longer in Russia. So, that is an important lesson. Even if you're a billionaire, it may not, you may not sleep well at night. I would much rather take my sleep over his personally. Yet, what he did is they Yandex sold their Russian assets for several $billion, so no longer a Russian company, and really you have just some straggling assets. You have a data center in Finland, several hundred engineers that are focused on artificial intelligence, and then a commitment to say, look, we're going to build some AI infrastructure that gets several prominent investors to go, yeah, let's put up $700 million. That includes NVIDIA, the maker of these cutting edge chips. So when you look at Nebius now, this is a company based in Amsterdam. They have research hubs in Israel, North America, and Europe, several hundred specialists, NASDAQ listed, billions of dollars in cash on the balance sheet. There's a lot of different pieces to the thesis. You have the infrastructure, which is the Nebius core business, which is about building this AI-centric cloud platform. But they also have a lot of other things. Toloka, which is a data partner for those folks looking to build these different models. They have Avride, which is autonomous driving. So this is self-driving and delivery robots. They have a 28% stake in ClickHouse, which I think is a database management software. They also have a edtech, or a technology platform, an edtech platform, which is about reskilling people in what could be a very disruptive environment because of how fast AI is going. So there's a lot of different pieces to the thesis. However, Nebius is the vast majority of their revenue. And when you think about this, right now, it's predominantly, 14,000 GPUs. They're looking to expand this by tens of thousands of GPUs. And their goal is to get to roughly $1 billion in annualized recurring revenue next year. You do have that cash. You do have access to capital markets, AKA they're going to be issuing stock. They do have these other segments, and they do have this stake in ClickHouse, which, might be worth, let's say, around $500 million. So you have all these different pieces, looking at Nebius. When you think about what they're trying to do and what they're trying to address, they're really trying to offer GPUs, graphics processing units, as a service. Think of it as a capital-intensive leasing business. They buy the GPUs and then they lease them out to customers. And they think that by 2030, this will be a $260 billion market, and it's growing at 30% plus in the years ahead. And they think they can be one of the players that provides this critical GPU as a service for all the customers that don't want to invest in the GPUs or can't even get access to it. They have that sort of advantage. And they also think that relative to their competitors, they're going to have a cost advantage. And we're going to talk more about this dynamic towards the end of this video, but this is a key part of the thesis. Them thinking, hey, we can get a 20 to 25% cost advantage, on a dollars per GPU per hour. And they think it's based on customizing their servers and customizing their data centers that they can squeeze this cost out versus competitors. And if they can, if you're a capital intensive business, that is a key differentiator. That would mean they could be a winner long term. Either way, they're planning on expanding their GPUs, investing in their infrastructure by growing by multiples, 4 to 6x, in this next year. And that's going to drive their annualized recurring revenue from under 200 million at the end of last year to nearly $1 billion at the end of this year, and then possibly billions of dollars in the years ahead. So this is the story: investing in lots of GPUs, investing billions of dollars in GPUs to drive billions of dollars in revenue as GPUs as a service. That's how you should think about this business. That said, it is, it's not when you're capital intensive, that inherently means a lot of cash flow is going out. So you need to have that free cash flow, and that's going to be one of the key challenges they face, because even if revenue is expected to grow exponentially, so is their capital expenditures. And so next year, you're talking about a cash burn of hundreds of millions of dollars, if not billions of dollars, because they're talking about CapEx between 600 million and 1.5 billion dollars. So huge cash burn as they're investing in these GPUs. So what are my thoughts on Nebius stock? First of all, as always, this is not financial advice. Earlier today, a member of the Unrivaled Investing community asked me to look at Nebius. So that's why I'm looking at it, because it caught my attention. Their fast growth, the management alignment, I love to see it. And just yesterday, quick plug, Zeus M, a premium member of the Unrivaled Investing community, he shared the following. This is a direct quote: "I think not only you deliver great value, but also you created a great community." He's talking about the Unrivaled Investing exclusive Discord. This follows Henrik, another premium member, saying, "Subscribing to your platform is the best financial decision I've made in my life. Thank you very much. If you're looking for compelling ideas, come check out Unrivaled Investing." There's a lot of sexy stuff here with Nebius. I love to see the autonomous vehicles. I love to see another player. They do have like a partnership with Uber that they've announced. They've given tens of thousands of rides. They also have delivery robots. This is exciting stuff. I love to see these different pieces. And they also have these other segments, unclear the value, and they're clearly tapping into a huge growth market with GPUs as a service, looking to grow from $33 billion market to $260 billion plus. And it's a beautiful business, because if you truly are able to lease these GPUs out, you can create these long-term contracts that are very visible in terms of recurring revenue and potential profitability. So I like what I'm seeing. I like what they're building towards. And so let's go through this investment checklist, because I think most companies, 90% plus, fail. And I think this one possibly fails as well, even though a lot does check out. So aligned management, frankly, I love it. This is like 10 out of 10 when I'm thinking about aligned management, because not only do you have the founder, significant skin in the game, but they've done it before. I love to see when a founder has built a previous successful business, and then they're saying, yeah, I'm going to take the same playbook. I'm going to take what I learned and apply it to this business. That, in my opinion, increases the odds of a more favorable outcome. And by the way, when he was running Yandex, he previously had this experience building out huge data centers. So they know something about building these low cost and efficient data centers. So I like the aligned management. Compelling valuation, we'll talk about in a second. Obvious growth potential. This does strike me as obvious, but I think you need to dive in a little bit more in terms of thinking about that potential. And that gets to their point earlier about having some sort of cost advantage. And the reality is, it's a cost advantage relative to whom? Well, they're talking about hyperscalers like Google, Amazon, Microsoft, large private clouds like Meta, Apple, Tesla, and then just a few sizable specialized players. That's where they seem to fit in. And, they're saying, look, these hyperscalers and large private clouds, they're most likely going to consume their own compute internally. And so the independent market is really going to be these specialized players. And that's where, they're going to have capacity of hundreds of thousands of GPUs. I personally find it difficult to believe that NBIS or Nebius will have an advantage over these hyperscalers that are generating tens of billions of dollars in free cash flow. Just, I think last week, the CEO of Microsoft's like, look, I don't know about this $500 billion Stargate, but I'm good for my $80 billion next year. I mean, that's a drop the mic sort of moment. You have Zuckerberg with Meta talking about, I think, $60 billion. Throwing around that level of free cash flow is a huge advantage relative to Nebius, where you're trying to get to scale from a standing start. You have a couple $1 billion in cash on the balance sheet. That's nice. That's how much Microsoft's generating in a couple of weeks. So, it's not that, it's a huge, in my opinion, it's a huge disadvantage that they're in, just because the excess capacity will just crush these sort of independent players, I would think. So overall, it's too early for me to believe their infrastructure segment has a true advantage over their competition. I mean, if anything, they have a cost disadvantage as their competitors can order at scale. And, let's think about this for a second. You really think Nebius, that's going to, customize their servers and customize their data centers, are going to have some sort of advantage versus Amazon, AWS, spending tens of billions of dollars? You really think NVIDIA is going to give Nebius a better discount on buying in bulk than Amazon, Microsoft, Google? I don't think so. Like, it would be insane just from a policy perspective for NVIDIA to do that. So I look at this thing thinking to myself, you're automatically at a cost disadvantage because you're probably going to have to buy your GPUs at a higher, effectively markup. And then, the whole argument about customization, well, they're doing their own customization as well. They're doing their own optimization for scale. So talking about this 20 to 25% cost advantage per GPU, I'm just not so sure about that. I would need to see it. This is you need to show me before I'm willing to buy it sort of thesis. So let's think about the valuation. So that alone makes it a little bit hard for me to believe that the opportunity is as obvious, because when you're thinking about opportunity, you're not only thinking about the growth, which is obvious. Yes, you're going to grow your sales a lot by investing in these GPUs, but what's critical is thinking about that free cash flow that's going to come with it. And what they're saying is, yeah, we're going to have to issue a lot of stock because we're not generating tens of billions of dollars in free cash flow like these hyperscalers. So it's tough. It's super tough. Thinking about the valuation, $32 per share, roughly $7.5 billion market cap, roughly. Yes, they do have $2 billion plus in cash on their balance sheet. I wouldn't count it though. I wouldn't think about that, because that's entirely going to be going into buying those GPUs for NVIDIA. And they've pretty much said that. So and that's going to be what's driving their ARR growth. So, it's really a question of, where do you think their ARR, their annualized recurring, what do you think their sales are going to grow to in the next few years? Yes, they do have these other assets, these, driverless assets, driving robots, educational companies. All in, I suspect that's under $1 billion valuation. If someone has a better perspective on that, I'd love to hear it. So it's really, can this $1 billion in revenue that they're expecting next year, this annualized recurring revenue, so the end of next year, is that worth $7.5 billion when there's going to be, huge cash burn because they're investing in buying more and more GPUs? So I personally, as I look at these types of plays, which is a capital intensive, effectively leasing business, you're buying these products and then you're leasing them out and hoping to get a nice spread. Personally, I look at it as, you would want to think about what's the price relative to the inherent assets, like the intrinsic assets, and sort of buy it relative to the net asset value. And if you could say, hey, they've invested this much in their infrastructure and you're able to, buy it for around that, that's when you have that sort of compelling valuation. It would not surprise me if this is worth a lot more in the future, because you're sort of making this aggressive bet of taking all this cash and investing and buying GPUs and then expecting to lease them out. But, if a bunch of other players are assuming the same sort of business model of, hey, I'm just going to invest a huge amount in GPUs and then lease them out, you could have some sort of issue in the future of, mismatched demand and supply. So I look at this, it's just too hard for me. When I look at Nebius, wouldn't surprise me if it's much bigger in the future, because they're making this aggressive bet in AI, and I am a believer in the AI revolution. But I'm looking at this, I like the founder alignment. I like, that they've done it before. I like the net cash balance sheet, but it's just too early for me to say definitively, yes, you have that competitive advantage that's going to drive the returns over time. I need to see something that makes it more obvious to me personally. If you have a different take, I'd absolutely love to hear it in the comments below. Thanks so much for watching Unrivaled Investing.